Hello and welcome to Cafe Mutual YouTube channel. Friends, one of the short way to create wealth is investing in quality companies. While it is the job of fund managers to shortlist quality companies, what if I tell you that you can invest in an index fund that can give you exposure to the top 50 quality companies of India? In this context, Nippon India Mutual Fund has recently launched Nippon India Nifty 500 Quality 50 Index Fund. To give us more insights on this, we have Arun Sundaresan, Head ETF Nippon India Mutual Fund. Arun has over 2 decades of experience in product management, sales, and distribution. So let's invite Arun. Good morning, Arun, and welcome to the show.
Hi, Nishant. A pleasure being in the show. Thank you very much.
Great, great. So, Arun, my first question to you is that many MFDs prefer actively managed fund to generate alpha in their client's portfolio. So why should they consider smart beta funds, especially if they have had success with active strategies?
So, Nishant, I'll come to the smart beta a little later, but the question is largely why even select an index fund when there are a lot of active funds through which the MFTs can add a lot of value and they can generate alpha. So, I'll
Right.
tell you this discussion about active, passive, etc. There is only one leg which is different when it comes to active fund management, which is the last leg wherein a fund manager actively decides as to what stock to buy, when to sell, how much cash call to take, etc. Only that part is not there. But rest of the things, when it comes to MFDs, when they are recommending a passive fund, everything else is the same. It's the same market. You still need to make asset allocation. You need to decide for your client how much equity to give, how much gold, how much debt allocations to give, etc. Once you decide, okay, this is the allocation, within equity, should I give broad-based products like Nifty or mid cap, small cap? How much sector thematic? What kind of sector themes can I give? Then all these smart beta through which you can add tremendous value and even alpha through these products. All these things are common for both active as well as passive fund, and there is tremendous value to be added by recommending. For example, let me tell you, in the last 6 months, for example, had you recommended more of gold allocation than equity, today on hindsight, it will look extremely good. Within equity, had you recommended more of large cap, it would have looked extremely good. Within equity, if you recommended a bank index fund instead of a IT index fund or any active fund which had more IT, then your recommendation, your value addition would have been very, very different. So there is tremendous scope. There is a lot that you can do with passive funds, and through them add significant value. And within that, smart beta is a very specific category where the design itself, the index itself, is designed in such a manner that it can potentially outperform the broader market. So even within those passive funds, you can generate through a systematic manner, through a rules-based approach, you can generate potentially alpha when compared to the broader market. And by recommending them, and it's very interesting when our partners go and explain, there is a lot to talk about, even in these products, saying what exactly they are, how are they trying to generate that additional return, in what kind of conditions it will work, what are the drawdowns, what are the long-term return profile, where will it sit in your portfolio, and so on and so forth. So there is tremendous value addition that partners can do with passives in general and smart beta passive funds in particular.
Great. Arun, Nippon India Mutual Fund has recently launched Nippon India Nifty 500 Quality 50 Index Fund. So, what is the rationale behind this launch? Also, can you take us through the underlying index?
Sure. So, as you rightly pointed out, this is an index fund whereby the index provider has already constructed an index,
Mhm.
and like any other index fund, we will be replicating. But this index fund is based on the factor called as quality. The quality is a fundamental factor. So, unlike certain factors like momentum or alpha, which are based more on the price returns, quality is a fundamental factor. So in this particular fund, there are different ways you can define quality, right? So there are multiple ways you can define quality, but in this particular fund, quality is defined through three parameters. One is ROE, return on equity. Higher the return on equity, the better. The second parameter is debt equity or leverage, right? The lower the debt equity, it is good. So basically, what we are saying is that high returns cannot come on the back of leverage. You cannot take debt and that results in high ROE. That is not what we are trying to look at it. So not only should ROE be high, the leverage also should be low, debt equity. That's the second parameter. The third parameter is EPS. EPS growth consistency. So basically, the earnings per share has to be consistent year on year for the last 5 years. So basically, you do not want companies which are for various reasons. It could be because of high leverage. It could be because of the nature of the business itself, where it is cyclical. You do not want earnings fluctuating too much. So you want consistency in earnings. So these three parameters are assigned one third equal weight, that is ROE, debt equity, low debt equity, as well as consistency of EPS growth. So that those are the three parameters. You give one third weight. Only for financial companies, banks, NBFCs, insurance companies, any financial companies, debt equity ratio is not considered because inherently many financial companies, the nature of the business is they will borrow, they will lend, so looking at debt equity may not be meaningful. So in those cases, equal weight for ROE and EPS consistency is assigned. Otherwise, the method is as simple as that. So by doing that, out of Nifty 500, you will pick up the top 50 stocks in terms of quality as they qualify. So they become the portfolio. But to decide on the weight, so once you identify the 50 stocks, the actual weight will be a combination of this quality factor multiplied by technically the square root of the free float market cap. So it's not just based on the factor. We call this method tilt weighted method. It also considers the size of the stock, size of the company, and it is relative to Nifty 500, right? That is the parent index. So essentially, you have a quality portfolio which is picked up by identifying three factors, and you have 50 stocks from out of Nifty 500 universe. So the rebalancing is on a 6 monthly basis. Every June and December, the parameters will be considered, the exercise will be done, and the changes, if there are any, will be made to the portfolio every 6 months.
So, Arun, among smart beta strategies, momentum and alpha factors have outperformed the quality factor across various time frames. So, why should investor consider investing in quality factor index funds?
So, Nishant, you will appreciate that all these products you mentioned, momentum, alpha. Now we are talking about quality. Yeah. All these are equity products per se to start with, and they carry the inherent risk and return of equity asset class. But having said that, within equity, different parts of the markets, different segments perform very differently from time to time. Just to make it simple, for example, all of us know that large cap, when compared to small cap, the risk return profile is different, right? You will associate small cap with higher return. At the same time, it can have higher volatility or higher risk associated when compared to large cap. Similarly, when it comes to these different smart beta products, momentum and alpha are on the aggressive side. In the longer term, yes, the return profiles are amongst the best. They tend to give you the best return over a period of time. But the drawdowns, especially when sometimes markets go through correction, etc., the downside, the drawdowns can be very significant. Just to let you know, in the last 6 months or from the peak of the market to now, strategies like momentum and alpha have fallen by almost 30%. Now, in the longer term, yes, they give good returns, but many investors may not be comfortable having that kind of drawdown. I invested 1 lakh, suddenly it's become 70,000. Array, what kind of strategy have you recommended? So you need to have that understanding. It will clearly suit those investors who do not mind that volatility, do not mind that very large drawdown that can happen time to time for the longer term return. On the other hand, if somebody says that, look, I want equity returns, but at the same time, I do not want this kind of drawdowns to happen in my portfolio. I want my returns to be relatively consistent. So that's where smart beta strategies like quality score, the return profile also is reasonably good over a period of time. No, though it is not as high as momentum or alpha, but very, very decent. At the same time, the other metrics like risk-adjusted return, drawdowns, etc., will be very different and very, very palatable when compared to these strategies like momentum alpha. So that's the difference. One has to see this as a spectrum. The risk-return profile within equity, varies, and one has to see the suitability of investors. So that's where this particular fund can come in.
So, Arun, traditionally, identifying high quality companies is the role of active fund managers. Then, why should investors rely on a predefined formula through an index fund to invest in such companies?
So, index funds by nature are rules based. So, and in this particular fund, we saw what those rules are: three parameters, 6 monthly rebalancing, and of course, there are other nuances as to some stocks get eliminated based on certain liquidity criteria, promoter pledge, and so on and so forth. There is a very straightforward rules or a quant-based approach to picking up those 50 stocks. Yes, fund managers also, in a way, identify or rather use all these quantitative metrics when they, as part of their research, when they pick up stocks. But a lot also is based on their subjective assessment. So one is the past data. The other thing is they will also use their assessment to identify stocks and to weight the stocks, etc. A lot of times it can be right, it can also go wrong, and there are merits for both the approaches, right? And with active fund management, what could also happen is that today the style of the fund manager could be based on a particular style. For example, quality. He could be a little quality tilted. Tomorrow it might change to value. Tomorrow it might change to a combination, right? So you never know with a actively managed diversified fund. From the time you signed up to invest into that particular fund over a period of time, how things can change. It can work, it cannot work, it may not work, we don't know. On the other hand, here is a product. If you're very clear that, look, I want to play quality, and this is the definition of quality, I'm fine with it. It plays the entire market, Nifty 500, with no bias between large cap, mid cap, small cap, whichever are the quality stocks based on the rules that we already talked about, I'm fine. So this fund is going to remain true to label now and forever. So you have gone into a fundamentally good quality portfolio as per the definition, and perennially you're going to be on that. So if that gives you comfort, no cash call, it's going to be fully invested, it's an equity product based on quality as a parameter, I'm fine with it. I do not want any fidgeting within that. I start with quality, then it becomes value. When the fund manager moves to value, value is not performing, and vice versa. So many things can work. So the active call is a very different animal altogether. It can work, it can also not work. It's a double-edged sword. I do not want to do that. I want a good quality portfolio, and this serves my purpose. That's where a fund like this can come to the picture.
Arun, one last question. Why should MFDs recommend Nippon India Nifty 500 Quality 50 Index Fund to their clients?
See, Nishant, so this is a new fund. This variant is not available in the market. So this, as I said, the universe is Nifty 500, which means that it's going to be the stocks are going to be across large, mid, and small cap. So we've done back testing for the last 20 years. And when I'm saying back testing, this is not like an active fund. This is the index, right? So if the index were to be constructed, rebalanced like this for the last 20 years, how the portfolio looked like. Two things came out. One, the market cap variation over a period of time has been very dynamic. So between large cap, mid cap, small cap, it keeps changing over a period of time. So in a way, this is like a good flexi cap fund. So if you say that ideally, what would you want to do? You want to invest into a good quality. And when you're saying a flexi cap fund, you do not want to anchor yourself to large cap or mid cap. Let wherever markets work, let it be, right? So in a way, the outcome of this index or this product tends to be a good flexi cap. The normal flexi cap funds tend to be very static. If you notice, 70, 75% large cap, a little less, little more. This is actually exhibiting fair amount of flexibility. So to that extent, you can achieve the objective of investing into a good quality flexi cap offering through this particular fund. That's number one. Second, from a return perspective, when we did this rolling return analysis, forget point to point, sometimes it can be misleading. So at any point in time, if you had invested and if you had looked at 3-year return and looked at the average 3-year return over a period of time, this fund's return came to 16.4% CAGR. Now, just to put that number in context, Nifty 500 during the same time had given 12.7%. So 12.7, this is 16.4. And mid cap had given something like 15.7%. Small cap had given 13.4%. So this portfolio had hands down beaten Nifty 500, and even the strategies that we generally associate, mid caps and small caps, with high return over a period of time. Even those strategies, this is done much better. So that's point number two. Third, from a risk return perspective, if you look at return and then divide that by standard deviation or calculate return for every unit of risk that you take, that number also for every unit of risk, the return was something like two units of return for every unit of risk. So this number again for Nifty 500 was something like 1.7. So this was better than Nifty. Small cap, that number was 1. So on risk-adjusted return, for every unit of risk, if small cap generated 1 unit of return, this was generating 2 units of return. So not only is the return profile good, even your risk-adjusted return is very good. The last point is drawdown. And you talked about strategies like momentum and alpha. So this is a variant within Smart Beta where we talked about return, but even the consistency of the return through various metrics like risk-adjusted return or drawdowns also tend to be much, much lower, relatively lower when compared to the other variants and even broad markets like mid caps and small caps. So I would say that this is a reasonably good offering. And the last point I would say is that, and this is again true for any smart beta, the portfolios tend to be very unique and differentiated. Like, for example, many diversified funds, you just compare portfolios across different AMCs, you will typically have those usual suspects. You will have stocks like RAL, you will have stocks like HDFC Bank, ICICI Bank, L&T, ITC, the index heavyweights, a little less, little more, you will find across portfolios. Whereas here, whatever is the rules and based on the outcome, whichever is the stocks which are coming into the portfolio, those will be that will be your fund, that will be your portfolio. And you will notice that the portfolio, when compared to in general what you will get in the market, will be very different, very unique, which will help your purpose of diversification as well. So this is an entirely different offering, so to say. I think with all these 5 things that we talked about, it's a very decent offering.
All right. With that, we have come to an end to this interesting session. Thank you so much, Arun, for your time and invaluable inputs.
Thank you, Nishant.
And finally, I thank each one of you. Have a lovely day at work, guys. Thank you.